Hey everyone, this is Abhishek. I am going to describe one of the most important topic in the finance, that is the derivatives. Derivatives has the vast market in India and worldwide. According to BSC data, Bombay Stock Exchange from 2015-16, the transaction in the derivative is 1000 trillion dollar. That is again 900 times of the GDP of the India. It's a huge market. Derivatives has the four subcategory, that is forward, swaps, future and options. Forward and futures are almost same in the transactional manner, but slightly different in the regulatory. Like future is more regulated than the forwards, and it has more credit worthiness and less default risk than the forwards. In today's session, I will be more focusing on future and options, what is their concept, how we are going to execute the contract in future and option, and what would be their payoff diagrams, that is P&L diagram. Future is the contract between two parties which is regulated by the stock exchange. The two parties come in the picture in which the one party think that the price of particular underlying asset, that asset can be anything, include equity, debt product, commodity, currency or anything. So when one party think that particular underlying asset would go up, and the second party think that that would go down, and in this thought process the contract is going to be executed between two parties. Now I would like to take an example, one of my favorite stock, SBI, State Bank of India. The spot price is 247 according to yesterday market. So there would be two thoughts. The one would be like the price would go up, and the second thought would be the price would go down. So if I am thinking that the price would go up, I am going to buy the futures, and if I am thinking that the price would go down, I am going to sell the futures. So also we can say long and short. So if we are going to buy the future, that is we call long futures, and if we are going to short the future, that means sell the futures, we are going to say the short the future. If I am going to take a long in the future, my profit area would be A. That means if the price goes up after 247, that is the spot price, and strike price would be 250, 255 and 260. So if I am taking a long position in the future, and if the price goes up, we are going to make the profit. The profit area is represented by A. And if I am thinking that the price would go down, then I am going to short the future, and if the price goes down below 247, that can be 240, 235, 230 or below. So my profitable area would be B area, in which we are going to make the profit. Now I am going to describe how these transactions are going to be executed in P&L diagram. So here I have prepared the diagram. We can see here the spot price is 247, and there are various strike price that include 240, 235, 230, which is below the strike price, below the spot price, and here 250, 255, 260, which is above the strike price. I am going to demonstrate the long future transaction in the P&L payoff diagrams. So for the example, if the strike price is equivalent to the spot price at the expiry, either whenever we want to execute the contract, so there would be no profit, no loss. As we can see here, the spot price 247 minus 247, that is equivalent to 0. We are not going to make any profit out of this transaction if both amount are equal. Okay, now I would like to tell something regarding the Indian market. When we are going to transact with the future and options, we have to purchase the shares in the lot. So for the SBI particular stock, the lot size is 3000 for the future and options. So here at the spot and strike, when both are equal, we are not gonna make any profit. So this equal to into 3000. So that does not matter, whatever multiplied by 0. Now if we are taking that, we have taken the long position in the future. If the price goes up from 247 to 250, So here we are going to make the profit would be like 250 minus 247, that is equal to 3 rupees. So I am going to make a profit of 3 rupees per stock, and I have taken a one lot that contain a 3000 stock of the SBI. So 3 into 3000, so here I am going to make a profit of 9000 rupees. Now this is my favorable position in the market. If the price goes below 247, so I am going to make the loss because I have taken the long position in the market. So the loss would be 240, that is my strike price minus spot price, that is 247, equivalent to 7 rupees loss I am going to make. So 7, that is minus 7, again into lot size, that is 3000 for the SBI, we have taken the example. So I am going to lose 21,000 rupee out of this transaction if the position is not in my favor. We are going to make the rest calculation. 255 minus 247 equal to 8 rupees into 3000. Here I am making 24,000 rupee in my favorable position. If the price goes up to 260 minus 247, here I am going to make a 13 rupees into lot size, that is 39,000 rupee. Again, this is my favorite position. If the price goes down by 235 rupees, so strike price 235 minus 247, that is equal to 12 rupees negative. So minus 12 into lot size, here I am going to lose 36,000 rupee because the transaction is in not my favor. Whatever I thought, the price is in the adverse position. If the price goes down by 230 rupees and the spot price is 247, the spot price at which we have to execute the contract, so here that is minus 17 rupees into lot size, that is 3000. So here I am going to lose 51,000 rupee out of this transaction. Now, so this was the demonstration regarding when we have taken the long position in the future. Here, if we are going to take the short position in the future, that means I am anticipating that the price of particular stock, particular underlying asset will go down, and I have taken the short position in the future. That is also, we can say, the short selling. So we have done the short selling. Then I would like to demonstrate what is the P&L diagram look like when we are going to take the short position for the underlying asset. So here we can see I have taken an example for the future short. So the spot price is equivalent to the spot price here, so there would be no profit, no loss, because 247 minus 247 equivalent to 0 into lot size, doesn't matter. So if the price goes down below 240 rupees, so here we are going to reverse the calculation because we have taken the short position. So that would be 247 minus 240 rupees. So we are going to make a profit of 7 rupees for one transaction for particular stock. Into lot size we have taken a 3000. So here we are going to make a profit of 21,000 rupee. This is my favorable position, whatever we have taken before. If the price goes up by 250 rupees, so that is going to adverse my profit. So the loss would be 247 minus 250. So here I am going to lose 3 rupees per stock. So that is again into 3000 of the lot size. I am going to lose the 9,000 rupees. If the price goes up by 255 rupees, so 255, 247, that is spot price minus strike price is 255. So here I'm getting a loss of 8 rupees per stock. So minus 8 rupees I have taken per stock into lot size. Here I'm gonna lose this much money. same for the 260 rupees. So 247 minus 260 equivalent to minus 13 into lot size is 3000. So here I'm gonna lose 39,000 if whatever the position we have taken is going to adverse from my anticipation. Again, if the price goes down by 235 rupees, so I have done the short in the futures, so my profit would be 247 minus 235, that is equal to 12 rupees, yes, and into lot size. So I'm gonna make a 36,000 rupee over here. Again for 230 we are taking 247 minus 230 equal to 17 rupees per stock into lot size. So here I'm gonna make 51,000 rupee out of this transaction. So this was all about the how we are going to make the PNL diagram for the futures. Thank you so much for watching the video.